Recording this video Tuesday evening, the 26th of February 2013, and got a couple of emails today talking about gold. So I want to respond to those. It's not just about gold, though. I want to talk about kind of quantitative easing, central bank policies, and international kind of capital flows in a kind of broader context. And the first email was from Andrew, and Andrew says, "Hey, just wanted to tell you how much I appreciate all the Emini updates. They're excellent. I always learn something from them. Your gold call was epic, and I was able to make some nice short trades on a market I would never have looked at. May have to put you in the will." Nice comments from Andrew, thank you. In terms of, we've been talking about gold on the site quite a lot over the last couple of weeks, but that's just because we fell out of bed. We fell out below this kind of really important support level over the last couple of weeks, so that's why I've been talking about it quite a lot. But just to note, on the site, gold has been a topic for a very long time, and the kind of the best article that I've got on gold on the site is this one. This was published on the 25th of September 2011, and this was after gold and silver had both made pullback to end of trend moves on the weekly charts. And I talked about gold and silver in quite a lot of detail here about what drives the gold and silver market, in my opinion, and how you should look at it in terms of protecting your wealth from money printing, political unrest, and so on. So, it's not, gold is not like a little flash in the pan in terms of the Emini-Watch site. The weakness we've had over the last couple of weeks has been well telegraphed, with articles like this on the site. So, nice comments from Andrew. Let's go to Jeff's email, and this is what Jeff said. "I'm curious about your bearish view of gold when my better sine wave indicator is showing that monthly support is about to print a pullback on its way to an end of a decade-long trend. I see that as bullish for gold, bearish for the US dollar looking out a year." Now, Jeff's right. We've got, at some point, we will put in that pullback support level on the monthly chart. The question is, when is that going to happen? I'll refer to that chart kind of shortly. But then, these are the comments by Jeff I find quite interesting. "At the very least, downside would appear to be contained. Quantitative easing is not ending. Bernanke was clear about that today." We're talking about Humphrey Hawkins' kind of testimony in front of the Senate Banking Committee. "And gold surged appropriately. Why the dollar keeps believing that QE is ending is beyond me. But the dollar strength could be temporary, and we have more to do with sequester issues in the US." Now, so Jeff, good comments about quantitative easing. And if you think about quantitative easing as kind of printing money, if you print more of that money, it devalues the value of your currency. And if we've got more kind of currency out there, gold is not increasing in kind of the total quantity available kind of year by year. If we've got a fixed amount of gold, but more and more paper notes out there, the value of gold will go up because we just have more money chasing that kind of gold. Now, that's true in a kind of vacuum, if you like. If you're just looking at the US economy and you're saying, total dollars outstanding and the total amount of gold, and one is increasing faster than the other, the price would go up. But you can't look at the US economy in a vacuum. It happens in an international kind of context. And yesterday we had a beautiful chart that came up on Zero Hedge. So hat tip to Zero Hedge, always putting up kind of good stuff here, and this was the chart. There's been various versions of this out over the last couple of years, but this was kind of a current one, and it was kind of topical. And it prints the percentage, the central bank balance sheets as a percentage of GDP, of the national kind of GDP. On a scale of kind of 0 to 60%, we've got a bunch of countries here. So let me just go through these. So first of all, at the top of the chart here, coming up to 60% is Switzerland. Then we come down and we've got Japan. Then we've got the Eurozone after that. And then we've got the UK. And then finally at the bottom, less than 20%, is the US. So this shows the balance sheet, the expansion of the balance sheets by each of these kind of nations around the world. And it shows that, in an international context, the quantitative easing that's happening in the US is, lightweight compared to what's happening in Switzerland or Japan or the Eurozone or the UK. So those countries internationally are printing far more of their currency than the Fed is printing of US dollars. So on an international kind of context, the amount of quantitative easing and money printing that the Fed's doing is smaller. So there's more of those currencies about. So if they're devaluing their currency faster, you'll have the US dollar strengthening because we have greater money printing happening by the international central banks kind of around the world. So that's kind of responding to this point about looking at quantitative easing, and looked, as a vacuum, with the US economy alone, your comments would be correct, Jeff, but you have to look at the international context and see what everybody else is doing. So because these other nations are printing far more of their currency than US dollar, that's why one of the reasons why the US dollar is kind of strengthening. The other reason is capital flight. We have real problems in Japan and serious problems in Europe. So now, just as an example, let's talk about Switzerland, because I find the Swiss example to be just mind-boggling. Okay. Now, let's get some later kind of numbers. Seemingly these were kind of up to date, kind of towards the end of 2011, and we had the Swiss central bank with assets on their balance sheet up to 60% of GDP. So first of all, let's look at what those are, and we can go to the Swiss central bank's website, which is a lovely little website, very nicely organized, all in English. Thank you very much. And here's their balance sheet as of the end of 2011. And this is in billions of Swiss francs, so CHF Swiss francs. Now, for all intents and purposes, 1 Swiss franc is roughly equivalent to 1 US dollar. So when you see 1 billion Swiss francs, it's roughly 1 billion US dollars. Now, this is at the end of 2011. We had 350 billion Swiss francs on the balance sheet of the Swiss central bank. And the majority of these here in yellow, you can see, is foreign exchange reserves. They're quite a lot of gold. They're actually kind of tied to a policy to have a certain amount of their balance sheet in gold. But the vast majority of their balance sheet is actually in foreign exchange reserves. Okay, unlike, for example, the Fed balance sheet, where most of it's in government bonds, U.S. government bonds. So they have all of this in through intervention into the FX markets. They have foreign exchange reserves. Then we can go and have a look a little bit more detail. What are they actually holding? So you can look at this kind of broken down. So this is the balance sheet in terms of what they hold. 50%, 49% of it is in euro denominated assets. 28% is in US denominated assets. And then what kind of assets are we talking about? 82% of their balance sheet is in government bonds. And interestingly, 12% is in equities. So they've actually intervened in the equities markets as well as the bond markets. But for all intents and purposes, all of that money that they've got on their balance sheet is Swiss francs that they've printed in order to buy European bonds. Now, they're not buying any kind of dodgy periphery stuff. They're Swiss. Okay, they are buying German bonds predominantly. I would have thought, low risk kind of, and that's one of the reasons why the yields on German bonds is so low, is that you've had a massive amount of money printing in Switzerland in order to buy European bonds. Now, let's update these numbers a little bit, because I've got a couple more kind of data points here. So this is kind of the beginning of February 7th. This is Wall Street Journal. So the Swiss currency reserves have now reached $427 billion. So remember, when we go back to this initial chart here with the asset structure, we were talking about this is end of 2011, 350 billion Swiss francs. It's now up to 427 billion. Now, in terms of what does that represent? So this is a website to do with the Swiss central bank kind of commentary. So the Swiss National Bank holds foreign reserves equivalent to 86.5% of its balance sheet. So all of its balance sheet is foreign reserves. This balance makes up 83.2% of Swiss GDP. Up from 57 in 2011. 4 years ago it was less than 10%, something like that. So just think about this. This is absolutely mind-boggling to me. This is the Swiss central bank has printed Swiss francs to the tune of, in round figures, 100% of their national income, and gone out and bought euro bonds. So government bonds. In fact, when you look at the commentary, it's not just government bonds, it's quasi-government bonds. It is some high quality kind of corporates and so on. But effectively they are buying bonds in the European market in order to depress the price of the Swiss franc. They've had to buy euros. Now, this is a bet they're making. They're betting the GDP of the country buying German bonds. How they unwind this, I have no idea. Why someone like the Swiss have allowed, they're such a sensible nation, they've allowed their central bank to go out and gamble with that much money printing is unbelievably extraordinary to me. Now, let's go to a couple of charts. Let's just look at the Swiss francs. This is weekly chart of the Swiss franc, and I've got the euro here kind of down below. The reason why they did it was in 2011, we can see here, you had this huge spike in the Swiss franc. So the Swiss franc had been trading around, whatever, 95 cents versus the US dollar. And it had spiked up to 140, 145, something like that up here. Now, what was happening at the time? We have a collapse happening in Europe. We have a Great Depression happening in Greece. We have a Great Depression about to happen in Spain. It'll probably be visited on Italy too, and probably France eventually as well. The only countries in Europe that are kind of safe, Germany and the northern kind of countries, so Denmark, Sweden, Finland, so on. Now, what was happening at that time in the middle of 2011, we basically had all the problems come to the fore. The Swiss banking, the European banking system was at risk of collapse. We had potentially the Greeks kind of exiting the eurozone, and panic, absolute panic, huge outflows in all the banks in Spain. All the money had been drained out of Greece, and they were taking that money and putting it in safe places. One of the safest places they could go to was Switzerland. People opening Swiss banks, buying Swiss francs, getting their money out of euros because they did not know what was going to happen. I'm sure the money went to the UK as well, to Andorra, to the Cayman Islands, to the US, Hong Kong, you name it. But this showed that capital flow, panic buying of Swiss francs to get out of euros. And the Swiss central bank said, that's too high. None of our domestic kind of businesses can export at that level. We're at a severe disadvantage, and we're going to intervene into the foreign exchange markets. They'd make an electronic entry in their balance sheet. They print electronic Swiss francs, and they go out and buy European safe-ish assets, whatever, German bonds and so on. And they have depressed the Swiss franc in that way by buying overseas assets. European predominantly, bought some US and some equities, not just bonds, and they've driven down the price of their Swiss franc. Now, to the tune of, in round figures, the total income of a year's income of Switzerland, the entire country. Now, during that time, if they were buying to drive down their currency, they've been buying European assets, they've been buying euros. This is what happened to the euro over that time period. You can see the euro actually went down from 145 to 125 or whatever. Had a little bit of strength kind of lately. But that's an entire country. I mean, Switzerland is roughly the size of 6 or 7% of the US in terms of population, GDP and so on. If the US GDP is about 15 trillion, the Swiss GDP is in the order of 750 billion Swiss francs, something like that. That's kind of order of magnitude. It's a big deal. It's a big country. To spend to print money worth their entire GDP and then go out and buy euros. And even with that amount of buying happening in Europe, that's all the euro could do. So if you think, if the Swiss weren't doing that, how low would the euro be now? It'd be decimated, I would suggest. Now, I don't know how they unwind this. At some point, they talk about these being kind of short-dated kind of maturity bonds. So presumably they're kind of rolling those over, kind of month by month, quarter by quarter. I don't know specifically how it works. I wish I was, a fly on the wall, looking in on their kind of meetings and the in the offices of the risk manager at the Swiss National Bank and trying to understand what's kind of going on. But the bet they're making is kind of huge. So again, just going back to Jeff's comment, this is all right in context of the US, but you have to look at it in the context of internationally. And countries like Switzerland are making a huge bet, and they're printing far more dollars than the Fed is. So Fed's sitting at 20% of GDP in terms of the zero hedge chart. So this is the Fed kind of down here, and you've got extremes like Switzerland going on here. Now, I've used Switzerland as kind of an example because their balance sheet is fairly clean and it's clear what they're doing. They're actually intervening in the foreign exchange market. I don't understand the Japanese central bank's balance sheet or anything like that. It's not that I really understand the balance sheet, the Swiss one anyway. So I'm just kind of my amateur views on what's kind of going on. But Switzerland, just using an example because it's kind of extreme. But all these others are just as bad. They're a lot worse than the US. So you can't look at just the amount of quantitative easing that's happening in the US alone. You have to put it in an international kind of context. So that's the first kind of comment about quantitative easing. Now, the second kind of comments are more to do with kind of international flows, and I find this kind of fascinating because gold is an asset class, if you like, but everything's connected, and you have to look at where the money is flowing. First of all, into which countries, from which countries to which countries, and then from what assets into what assets. So in terms of countries, you broadly kind of break down into two. You've got kind of the US dollar, and you've also got the currencies that are pegged against the US dollar. So we've got the Hong Kong dollar, for example, to some extent the renminbi, the Chinese currency. You've got the Singapore dollar as well. It's more a trade-weighted kind of basket of currencies, but you've got the US dollars and the currencies that are pegged against the US dollar versus the rest, and the rest is kind of viewed as kind of risk-on currencies. We've got the euro, the pound, the Aussie, the loonie. We've got the Swiss franc as effectively they're pegging that to the euro. We've got the Brazilian real and so on. But in terms of the major ones, these are it. And then gold is part of that. So gold is kind of the inverse of the US dollar. So you kind of look at gold as being tied to these other kind of currencies. But that's kind of one side of the matrix is which currency, US dollar versus the rest. The yen used to be, I used to think of it as kind of a carry trade currency. It kind of more resembled the US dollar because you'd borrow money in low interest rate currencies and then kind of invest in high interest rate currencies. And so the yen used to be kind of one of these carry trades and was more akin to the US dollar. But what we've got at the moment is we've just got capital flight in Japan. So it's like money is just leaving the country, and we've had in the last 4 months just a massive decline in the yen. So at the moment, for the time being, it's kind of disconnected itself, if you like, from those kind of things. But which country? US dollar versus the rest, and then which assets? And effectively, you got equities, bonds, commodities, three kind of asset classes. I wouldn't put property in there. Property from time to time becomes a little bit of a tradable asset, a bubble, if you like. But effectively, a house is where you should live. You shouldn't be speculating on your house. So it's not really, and there aren't really kind of tradable vehicles for property. It's not like you have kind of futures and indices and so on. So really we're talking about equities, bonds and commodities. So from where is the money flowing to where, and then to which kind of assets. My view of what's going on at the moment, we have a collapse happening in Japan and in Europe. We've got a Great Depression happening in Greece. We've got Spain falling over. Italy will be next, then France. It's not. I'm not talking days, weeks, or months. We're talking about the next several years. But it's in process. So we've got a collapse happening in Europe. We've got a collapse happening in Japan, and the money is flowing to safe havens. And so the money is flowing out of those countries, and the safest haven at the moment, because it's kind of the strongest nation at the moment, is the US. So it's the least ugly kind of option at the moment, and so the money is flowing into US. And where does it flow when it kind of panics? Well, short term it kind of flows into bonds because it's safe in bonds, and if it wants to take some risk, it'll buy equities as well. So that's what I see kind of going on, kind of broadly speaking, and that's why we're seeing strength in the US dollar. It's not just the quantitative easing in the other countries. It's also a capital flow. We've got flight to safety into the US dollar kind of happening right now. It has been into equities. Equities have been quite strong, but it's also kind of happening into bonds. And so let's just look at the dollar index chart. Again, been talking about this, the weekly chart. We've been basing for the last couple of years. We've been kind of moving around this kind of 70, mid-70s to 80 type level. And the last couple of weeks, we had these blue professional bars came on at cyclical low. We've been testing this kind of area previously. We have blue professional bars kind of coming in, coming here. We've not been selling down. We've kind of been breaking out. So we've got that strength in the dollar index kind of going on, and then gold will trade off the reverse of that. Now let's just look finally at Jeff's kind of comment about this weekly support coming in on the monthly support coming in on the gold chart. And here's better sine wave printed below the monthly chart here. So we had this massive rise up to almost $2,000 in gold. Exhaustion selling blue professional bars at the highs, and we've kind of sold off. And yes, we've got this monthly kind of cyclical support in due at some point, but we need price confirmation with that on the monthly chart that we've not had. So it'll come in, and I get the story. I've said this all along. I understand the gold bug's argument for why gold ought to go up. I get that. It's a question of timing. When will it happen? We've had the first leg of it, a huge leg of it. I mean, let's face it. Since beginning of the new century, we've had a massive run up in gold. So it just topped out at 2,000, and so it'll find support at some point, but not yet. I talk about support levels and resistance levels on the higher time frames being matched with trend moves on the lower time frame. So you got a daily chart, which is equivalent to the lowest time frame when you compare it to a monthly chart, and we need to see the end of a trending move on the daily chart. And all we've had over the last several days is a break below that really important level. Now, I've been talking about the weakness that we've seen in gold because of the exhaustion buying, the flush patterns, and so on. And this break below support was, why I've been talking about this so much over the last few days. But we haven't seen a pullback to end of trend, and we're a downtrend on the daily chart here. We've had quite a lot of selling, and we bounced off there. But remember, we're in the zone here. This is where the professionals were selling down at this point here. So we've just bounced back in. The volume's been fairly decent as a bounce back in, but we're in the zone here. So support could become resistance. We kind of bounce back this until we see a pullback to end of trend on the daily chart. We won't have a kind of the first sign of a confirmation that we've got a support level kind of coming in here. The second thing that I'd be looking for is on the weekly chart is blue professional down bar kind of coming in at the lows. The highs were marked with blue professional up bars at the highs and testing back into these highs. We need to see blue professional bars at the lows and an exhaustion selling signal as well. So on the weekly chart, for that exhaustion buying, we need to see exhaustion selling that mirrors that. So nice little bounce for a couple of days here, and agreed, maybe it's kind of reflective of the comments from Bernanke today. But to end this downtrend, we need to see pullback to end of trend. We need to see blue professional bars coming on the weekly chart. We need to see an exhaustion selling pattern, and then price confirmation on the monthly chart. So at that point, then maybe we'll find some strength in gold. But until I see that, I think gold is still going to see weakness rather than strength. So, this is just a spike down at the moment. I know the gold bugs would love you to be buying right now and kind of supporting their cause, but I have to go with better signals, which say pullback to end of trend is what we've got to see first. Silver chart, similar pattern. So again, we're through here. We bounced back up into this sell zone again. Remember, we kind of had all this weakness in silver, blue professional bars, exhaustion, bearish divergence, rolling over, and we're below support here. Got to see pullback to end of trend. We had a little bit of a left shoulder marked by exhaustion selling. We've had one blue professional bar coming at lows on silver. That could be falling through the ice, or it could be an area where the professionals are kind of picking it up. We haven't seen exhaustion selling on the weekly chart, and on the monthly chart you can see yes, we put in our pullback level here. We're kind of coming back to test that level here, but let's wait and see. Let's see blue professional bars kind of coming on these time frames, exhaustion selling and so on. It's too early to call a bottom in silver or gold, just because we've not seen those pullback to end of trends. So yes, at some point this will come into play. That that monthly support will come into play, but just not yet. So quite lengthy. I hope that was interesting to you. I love talking about the international capital flows. At the end of the day, they're interesting kind of talking points and they're kind of bigger picture kind of views, personal views about what's going on. At the end of the day, you've got to go with the charts. They'll tell you all the information you use in order to kind of get in at the right spot. So I'll keep watching gold, find it fascinating. So hopefully, Jeff, that was kind of interest to you.